All right, today we're diving into a massive business case study. We're not just looking at any company, we're analyzing a true global force, Saudi Aramco. This is a story where the big strategic decisions aren't just about the bottom line. They're about navigating the shifting sands of global power. So let's get into it.
To really wrap your head around the scale we're talking about, let's just start with this number, $106.2 billion. That was Aramco's net income for 2024. A figure like that isn't just about being profitable, it's about having immense, world-shaping influence.
So here's our game plan for breaking down their strategy. First, we'll get a handle on their sheer size. Then, we'll unpack their core business model, which, as you'll see, is all about geopolitics. From there, we'll look at the three huge pillars of their strategy: the big pivot to China, a surprising shift to value over volume, and its role as the dividend engine for the entire kingdom. And then, the best part, we'll turn the final call over to you.
Okay, first up, let's try to put Aramco's power into perspective. It's one thing to hear these crazy, huge numbers, but it's another thing to understand what they actually mean out there in the real world.
A market cap of $1.68 trillion. That puts Aramco in an incredibly exclusive club of global companies. But check out the dividends, $124.2 billion paid out in just 1 year. To put that in perspective, that's more than the entire GDP of a lot of countries. It is, quite literally, the financial bedrock of the whole Saudi economy.
And here's what that really means. When you produce over a tenth of the entire world's oil supply, you're not just another player in the market. You're not just reacting to prices. Your decisions can actually set the prices. You are a market maker, and that gives you a profound level of influence over the global economy.
So, let's see how all that power gets baked into their core strategy. For a company like Aramco, you can't really separate business from geopolitics. You could even argue that geopolitics is their business model. They're navigating a world that's changing in some really fundamental ways, and their strategy has to change right along with it.
They're essentially dealing with three massive forces at once. In the West, you've got the energy transition and new regulations putting a damper on long-term demand. But in the East, especially in Asia, demand is absolutely booming. And then, back at home, there's this incredible pressure to generate cash to fund Vision 2030, which is the kingdom's huge plan to diversify its economy beyond oil.
So, faced with all that, what do you do? Well, Aramco's response is built on these three core pillars. First, you have to secure your long-term demand. Second, you have to be really smart about how and where you spend your money. And third, you have to perfectly align the company's financial success with the country's goals. Let's break down each one.
Okay, pillar number one. This is a big one. It's a very decisive, very strategic pivot toward Asia, and specifically toward China. Now, this isn't just about finding a few new customers. This is about locking in their future in what is by far the world's biggest energy growth market.
You can really see their thinking laid out here. The risk? Demand from the West is shaky. The fix? Go lock in demand where it's rock solid. China. The next risk? Competitors trying to muscle you out. The mitigation? Don't just sell them oil, physically integrate into their system. A perfect example is the $3.4 billion deal for a stake in Rongsheng Petrochemical. You basically become part of the furniture. It's a deeply geopolitical move, weaving Aramco into the very fabric of its most important customer for decades to come.
Now for the second pillar, and honestly, this one is a real head-turner. It's a complete 180 from what Aramco has been doing for decades. For as long as anyone can remember, the name of the game was always about increasing production. Well, Aramco just slammed on the brakes.
The old plan was simple. Keep growing. Push capacity up to 13 million barrels a day. The new directive from the top? Nope. Stop. Hold the line at 12 million barrels. Now, this is a huge, deliberate shift in philosophy. So the big question is, why on earth would they do this?
Well, a big part of the answer starts right here. $40 billion. That's the estimated capital they'll save between now and 2028 simply by not chasing that extra million barrels of capacity. That's a massive amount of capital being redirected.
And what this really signals is a very sophisticated, kind of cold-blooded calculation. Aramco has decided that in today's world, using its power to keep prices stable and high is way more valuable than spending billions just to fight for a little more market share. It's a pivot from brute force production to strategic, financial discipline.
So that brings us to the third and final pillar, which connects everything back to the kingdom itself. That $40 billion in savings has to go somewhere, right? This is where Aramco's role as the dividend engine for Saudi Arabia becomes absolutely mission-critical. To make this happen, they rolled out a new mechanism, the the performance-linked dividend. Think of it as a formal system to take a huge chunk of their free cash flow. We're talking 50 to 70%, and funnel it directly to shareholders. And of course, the biggest shareholder by far is the Saudi government. What this does is create this incredibly direct and reliable pipeline for cash. When oil prices are high and profits are soaring, that money doesn't just sit on Aramco's books. It's efficiently funneled over to help pay for all the massive giga projects at the heart of Vision 2030. It's a perfect alignment of the company's strategy and the nation's strategy.
So, there you have it. The 3 pillars of a geopolitical business model. 1. Secure demand in the East. 2. Prioritize smart capital over raw volume. And 3. Create a financial engine to power a national transformation. Now let's bring it all together and get to the bottom line. It's time to turn the analysis over to you.
So here's the central question of this whole case study. On one hand, pivoting to China and focusing on value over volume looks like an incredibly shrewd way to navigate the next couple of decades. But on the other hand, deliberately capping your own production capacity, that's a big risk. You might be ceding market share to your competitors in the long run. So, what's your take? Is this a brilliant strategy to hedge against a volatile future, or is it a misstep that might cost them their leadership position? Let us know what you think.